Good morning, ladies and gentlemen, and welcome to the 15th Annual European Government Bond Conference, for the first time in a virtual setting. For those of you who don't know me, I'm Adam Farker, Chief Executive Officer at AFME. I would like to thank you for joining us in this virtual environment as we all adopt to this new way of convening. Today, we are joined by over 200 AFME members, banks, sovereign bond traders, investors, regulators, and fellow industry professionals. Whether virtually or in a physical environment, I'm happy that we are able to come together to discuss such an important topic for our industry and share challenges that are currently taking place. Before we get started, I would like to go over some quick housekeeping. You will have the opportunity to engage with our speakers via Slido, which you will see on the right-hand side of your screen. There is nothing you need to download. You will be able to submit questions for the speakers and participate in any polls we may have during the panel discussions. If you have any questions, just pop by AFME's booth, where you can get in touch with AFME's events team. In addition, please note that following the content sessions today, the platform will remain open for networking. I want to say a big thank you to our partners who have made today possible: Citi, TradeWeb, MTS Markets, and Transfic. Please do be sure to visit their booths in the Partner tab on the left-hand sidebar. Each will have representatives available to chat if you have any questions on their content, products, or services. I would also like to thank everyone who has given their time and expertise to create today's program, in particular the industry-leading speakers who we will hear from shortly. I want to also take this opportunity to highlight some recent work we have published at AFME, which include our CMU KPI report, as well as our government bond data reports. A snapshot of the latest bond data report from Q3 and AFME's other reports can be found at the AFME booth, and I'm sure they will be of interest to many of you joining us here today. When we held this event last year, no one could have anticipated the amount of upheaval that the financial industry and indeed society would experience just 4 months later. The resulting impact has seen emergency fiscal and monetary measures beyond what we could have ever imagined. After a strong rebound in the summer, recent warnings from the European Commission suggests that despite forecasts of 4.1% growth, the second wave has set back Europe's path to recovery by at least 2 years before we see a return to pre-pandemic levels, indicating a bumpy road ahead. Today, we will be discussing the pandemic's ramifications to government bond trading across the industry, what the new normal may look like, as well as the hurdles and opportunities along the way. And on that note, I would like to introduce our first panel for the day, Trading in the Aftermath of COVID-19, which will be moderated by Nathalie Fillet, Business Manager, Fixed Income from BNP Paribas. I will now welcome Nathalie and our panelists on screen.
Good morning, everyone. I'd like to welcome you to our first discussion panel, which is trading on the aftermath of COVID-19. So my name is Nathalie Fillet, and I would like to present you our panelists. So we first have Maria Kanata, who is chairwoman at MTS. Then we have Ashlyn Colher from Citi, managing EMA rate e-commerce. Then Marek Post, Director of Treasury and Capital Market at the Belgian Debt Agency. Anthony Lineham, the Deputy Director on Funding and Debt Management at the Ireland National Treasury Management Agencies. And finally, last but not least, we have Gustavo Barata, Portfolio Manager at Intesa Sao Paulo Bank in Ireland. So, yeah, as Adam just said, what a year. You know, the COVID-19 indeed has changed our life, personal, professional, and also has led to a very strong and rapid reaction from public authority. They have definitely taken extraordinary measures to support our economy and the market. So I would like to start our discussion by an audience survey. So are these extraordinary measures becoming the new normal? So you can click on the screen to answer this question. Hello. So it looks to be a very strong yes. So 72% say yes, only 26% thinks that it's not here to stay. So now I would like to turn to the panelists and to see if they are sharing this way, this view. Sorry. So yeah, definitely the banks has played a much more important role when the market stops. Central banks coming, building up a very kind of virtual cycle of confidence. And we still expect them to do more in December. So my first question to the panel would be, have we become too dependent on central bank action? So we would like to take the floor. Maybe Maria, if you like to start.
Yes, sure. Thank you, Natalie. But I can answer simply yes, yes, at least for a number of government bond markets. It is the case. It is very evident that the intervention, the presence of the ECB has been absolutely crucial to stabilize the market, to live in an environment less volatile and more stable. In my opinion, yes. The question is for how much time this environment persists. This I'm not sure that this new normal will be for forever. On the contrary, I believe not. But for a while, in a medium-term horizon, this, in my opinion, is the case.
Okay, so thank you very much, Maria. So, Marek, maybe what is a kind of point of view as an issue, a sovereign issue? How do you see, the intervention of the central bank? Definitely, they have helped the market to normalize, to reduce the volatility, but at the same time, is that kind of chipping away at the free flow of bonds? So, has it impact? As you see the market liquidity on your debt and on the EGB debt in general?
Well, there's a lot of reactions to that. Of course, the impact of central banks' action on the market has been huge, and of course that was meant to be the case. The initial action that was taken was really to stabilize markets, to suppress volatility, to make sure that markets could start trading again in a more normal way. So in that respect, it was completely wanted that this impact was so big. Of course, going forward, and that's more your question about dependency. That's a more tricky question. Do we become too dependent on central bank intervention? I don't think so personally. I think that the ECB actions are in line with what they should be doing. And to me, what is good to see is that when we went through the first round of QE with a top in 2016, and when afterwards the intervention was reduced, we did see market forces at full play. We did see investor types coming back in, replacing the activity. So in that sense, I don't think that it is in some way breaking or hampering the government bond market. It is an intervention, of course. It has a huge impact, but in the way that I believe it should have for the moment, given the lack of overall demand in the economy.
Thank you, Marek. Maybe we can turn to the dealer side. Maybe Ashlyn, how do you see, as a dealer, the intervention on the central bank, as it impact the market liquidity? Maybe this is a question we can ask to Gustavo as well, which is, as liquidity is richer for client, is it change quite a lot the action from the central banks?
So let's just talk about liquidity for a minute. What we have noticed is that broker markets activity has increased. And for example, MTS Italy volumes are about 3 times more than they were this time last year. So, and even if you look at market depth, for example, it's reminiscent of pre-2008 times. So we're looking at, deep active markets. If you turn then to the client side, we're seeing equal, buoyant markets. Activity in October on client markets was very high, perhaps not as high as March, but certainly up there as one of the, high points of the year. Within that, again, Italy was super active, even more active than Germany in October. And as Marek alluded to, we actually have, investor types that don't normally participate in markets where there's QE, like hedge funds, for example. And we've seen them, actively participating. We've also seen flows from and participation from Asian clients, and this has been, a very welcome sign of confidence. So, what's going on? There's QE, lots of activity. I think that the first thing is that debt levels are very high. That's and likely actually to continue that way for several months ahead. And secondly, actually, probably more importantly, was the limit that was imposed by the EU per security. So as you know, the EU imposed a 33% limit on themselves, beyond which they wouldn't buy into any particular security across a defined set of securities. And this limit was very transparent, very clear, and the EU was particularly conscious about their impact in the marketplace, that their participation could cause a distorted market. And that limit was put in place to address such distortions. And in fact, we believe that limit has really helped to reduce and maybe alleviate the risk of distortions. And further, it's reinforced to the marketplace that free float hasn't been compromised. So I think those are really the key issues that have been helping liquidity.
Yeah, thank you, Ashin. So, yes, Maria, if you want to add something.
Sorry, because I answered to the first part of your question and not to the second one regarding liquidity. Under the point of view of MTS activity, what has been absolutely noticeable this year has been, apart a couple of months of troubles in March, April, what we observed, it has been in Italy an extremely strong performance with the volume traded that practically doubled in comparison to the equivalent period, the first 10 months of the year. In this year in comparison to the previous one. This for the cash market. But even bond vision, the client B2 client market, we noticed an increase of volume over 50%. Of course, Italy is the first and the most important performance in MTS markets, both cash and bond vision. But it is noticeable that, for example, we observed an increase of activity on the cash market for Germany. while in the other markets there has been on average some decline. While it is not the same for bond vision, where we noticed a recovery of trading for Spain. No, not so large, but relevant for Belgium, Netherlands, and Portugal. On the contrary, Germany and France were a little bit lower. So there has been a mixed picture, but in general, the activity, the liquidity was very, very strong, especially after the clear statement of the ECB to intervene actively, and even after the communication and of the willingness of the EU to be supportive and with a strong solidarity in such a moment in the Eurozone. This is what we have noticed in our market.
Yes, thank you, Maria, for this very detailed appreciation of the trend in the market. So yeah, we can see that liquidity remains quite important. Is it maybe from the client point of view, Gustavo? Do you have the same view and the same idea that we try to keep liquidity very, very rich, important to the final clients, which are to continue to play the sovereign state.
Absolutely, I think it's still very, very important. To reply to your question, first of all, on the ECB bond buying versus price action in the markets, I would definitely say that price action is indeed affected. So by the way of a presence of a reliable, rather predictable buyer in the secondary market, and how that reduces massively volatility of the bed type. So it's now a distant memory of those sudden, I would say, air pockets that the market hit, where dealers would suspend their quotes, and the whole price discovery process becomes difficult. And on the liquidity side, of course, the first thing that comes to mind is that having such a big buyer, markets may become less liquid. Of course, there is less available outstanding traded in the system, but I would say that definitely major imbalances have been avoided. Somehow, core markets especially have become less liquid, but contingent measures like the securities lending from the ECB have helped. So for all the programs, starting with the CSPP and then the PSPP from December 2016, and now with the PEPP from the start in March 2020, securities bought under that program were available to be repoed to be lent, so to dealers to take care of particular specialness. On the other hand, of course, some bonds have become and will become more special, and those bonds will be, of course, less likely to be pledged for liquidity operations by the ECB. And all in all, the system, I would say, is definitely balanced. It came to mind the fact that although it was a different program, but the original stated objective of the SMP, the Securities Market Program, was in 2011 to ensure depth and liquidity in those market segments which are dysfunctional. So even now, we must remember that having a liquid, functional, deep secondary market is very well present in the ECB considerations and the way they approach the market.
Thank you. Maybe also the way we say, and we all agree, the role of ECB has very crucial and will definitely help the market to keep a liquidity and a very good activity. We could say also that there is a very game changer maybe in the market is that we have seen more solidarity at the EU level, and especially with the role of a new large player in the bond market, which is the role of the EU, who will be becoming a very large issuer, much larger than before. So how do you see this impact as a positive? Maybe I will turn my question to Anthony and Marik to see their view from the issuer point of view. Could it be a structural change? Has it changed your issuance strategy? Is it also help the liquidity in the market? Maybe Anthony, if you would like to comment on this newcomer issuer in the market.
Yeah, I couldn't help but reflect last night that when we spoke at last year's APME conference, there was a session on the need for a safe bond. And in many ways now we have it. Because European bonds, if you look at it, the ESM had capital behind it, the EFSF was covered by guarantee. But these new bonds are going to be the several and joint liability of the European Union. Yes, they are limited in terms of there's a limited time horizon in which they will be issued, but the quantum is quite substantial. And so we have now a safe bond, and that is always very good for liquidity. There was a lot of argument that we needed more core safe assets in Europe. We have a lot of German bonds, etc., but still there was a need for this core European asset, and we now have it. And the precedent has been set. It also is very important in terms of the sense of solidarity it gives about the European Union, which is quite, say, different from maybe the early years of the last crisis. So I think it's a very important structural issue in Europe. It provides us with that core safe benchmark, and I think that will be good for liquidity going forward. Probably doesn't affect our own issuance in terms of the different countries, but it does provide another very big player. And so again, we'll have to coordinate to make sure we don't all issue on the same day. I think we've all shown quite an ability to do that already. So I do think this will help liquidity ultimately, because having a core benchmark like that is always good for liquidity.
Marik, would you share this view, or on the the becoming of this
yes,
new
no, absolutely.
kind
I
of
think,
competition?
Well, competition to some degree, but well, for example, Belgium and Ireland as well. By the way, we have already signed up to the SURE program, which puts us a little bit on both sides. So on the one hand, we're a participant in and beneficiary of funding through EU channels. On the other hand, of course, yes, there is a certain element of another issuer in the market. But as Anthony said, that is something that we have been quite able to manage in the past, and I'm sure that we will continue to be able to do that going forward as well. Of course, I think there's still a lot of political issues to be resolved around this. We don't know how lasting the program will be. But again, like we said, the fact that there is this precedent is huge for the market, and I think it's a very positive signal that the EU has given at a very critical and difficult moment. So from that perspective, it's certainly a very positive sign for the European markets.
Thank you. And this EU, we say we don't know exactly how long, it will, the program, we have a very huge program for next year, but we don't really know for the moment how long it will last. So maybe my question will be to Gustavo. How do you see trading the EU? Is it just it will remain in the class of SSA, or will the future trading will be more going toward a sovereign? What would be your view on this, on the way EU should be positioned in the bond markets?
Well, yes. To begin with, for the time being, the issuance has been, of course, very limited. So right now, it's a small outstanding, and it is EU debt is definitely behaving still like a supranational. So few outright trades, relatively low volumes, mostly in asset swap. But given the issuance we will have starting next year, especially, I don't see how it will not become a proper liquid quasi-government curve. So with beneficial effects, I would say, for the overall market, because in a way it will take some pressure off from the scarcity effect seen in high-quality liquid assets, and so especially core government curves, the Bund curve especially. So I would definitely, watch asset swap levels in core Europe, which should become should lose some tightness at least in the long run. And there is no reason not to expect, as I said, the EU curve to develop into a full-blown curve for zero risk or low risk pan-European government or quasi-government bond curve.
Yes, thank you.
Reinforce that, if I may, Natalie, I'll just reinforce
yes,
that.
Of course,
that
Ashley.
the size of the forthcoming issuance of 750 billion basically makes this issuer look like a government bond issuer, and analogous to Spain, almost the same size. But I would want to say that it really depends on the market structure objective of the issuer. If they want to sell under the current syndicated framework, and for buy and sell hold strategies to be locked away in portfolios, then actually, if that's the objective, that's fine. But if the objective is to create a secondary market, then a much more government bond style framework would be required. And that means, a system of auctions, taps, committed dealers providing two-way prices, Maria on MTS perhaps. So it really, again, depends on the market structure objective of the EU.
And do you think it will take kind of some time of, if it's becoming a regular issuer in the market, maybe it will have to put the kind of market structure, or does it should start already now, or we just go, on the way and see how it goes? Is it something that the market will adapt itself, or is it something that we should do?
I think it needs to be led by the EU in consultation with the market, but clearly Marek and Anthony will be closer to this.
Anthony, if you would like to intervene.
I'm not wishing to speak on their behalf, but from their own presentation, they made it clear that the SURE loans are their more traditional back-to-back loans and are therefore quite constrained. But when they come to the recovery fund and when there will be grants, etc., then I think there'll be more ability to develop a proper benchmark structure with two-way quotes, etc. I think to look at their initial issuance could be misleading, because I think the SURE structure and legislation constrains them into the way they issue bonds. And the really interesting part will probably be in the second half of next year.
Maybe we could maybe turn now to another, quite important topic that we have seen in the recent year. An important change was to be toward more and more electronification of the market. So the COVID-19 crisis, has it stopped or accelerate this trend from your point of view? Also working from home, we have seen kind of a lot of very big change in the organization of all our activities. So a lot of traders, clients working from home. Has it has any impact on the way more electronification. Maybe I can turn to Maria or Ashley first to give a view on this specific trend.
Yes. I believe that there has been just at the start of this new environment, that there has been probably some little slowdown in adapt the model of work in every sector, both on the investor side and also it has been a question of organization. But honestly, on the MTS side, only a question to adapt the connection to do home working and so on, because for the rest that has been quite easy. What we noticed is some initial difficulties, but now completely overcome from, for example, the new big investors that has entered the bond vision market. They had just decided to enter, but the lockdown occurred suddenly, and there has been some delay in become fully operational. But now I believe that all the market has been able to organize itself and working in a very, very effective manner. So I believe no big effect on that, and probably, generally speaking, some increase in the electronification of the markets in general. So personally, I believe that when this pandemic will be effectively fight, it should be also to find a compromise, because the dialogue, personal dialogue between players is also quite important in long-term view, but not a big problem now to go ahead, at least for a while, in such a manner.
Thank you, Maria. Maybe Ashley, you can see you're a specialist of e-commerce trading, so maybe you can add a bit of your comment.
The first thing to say is what we normally notice during periods of very high volatility is that clients revert to the phone. They re-establish or establish or utilize their already established relationships with sales. With trading, they need to have those discussions. They're very conscious even more during volatile times of information leakage and slippage. So, normally that is what happens. And in March, actually, that's exactly what we saw. We didn't see it because everyone was sitting at home, basically, but we heard that everyone's phones were ringing off the hook. Sadly, we just didn't participate into that together. What was odd, though, is looking at the proportion of volume done electronically in voice in client markets, it stayed about the same. And actually, digging deeper into that, what was happening is clients were absolutely, negotiating more trades by voice, but they still wanted to utilize the benefits of electronic platforms by registering those trades onto a platform and having it electronically processed through their systems, so-called process trades, if you like. And that also served the additional tick boxes for compliance, which are heightened in volatile times, like, immediacy of booking, reduced errors, full audit trail, best X policy satisfied type of thing. So that's kind of what helped the proportions stay about the same. Clients did continue to use the platforms for executing their smaller tickets. but the experience they got was much longer response times, higher no quotes during March, and that's because dealer algos were switched off. But they still wanted to use those platforms for the smaller tickets because they wanted to free up their time for the bigger tickets and talk about those. So, to go back to your original question on trends, I think the trend to electronification is nothing new, right? I mean, it's been happening for a long time. Has March accelerated that trend? It's not obvious right now. What we've seen after March is dealer algos are back on, the proportion of electronic voice is about the same, proportion of process trades is about the same. So, we just see more of the same. I would say, though, that clients are emphasizing more data collection. So there's a lot more interest in two areas: data collection and digitizing that, and post-trade services, and making those flows also much more digitized.
Thank you, Ashley. And maybe Gustavo, on the client point of view, are you still of a kind to trade very large size more by voice, and the smaller ticket just Ashley just said from electronic, or is it something that also is changing from a side?
Sorry, Natalie, I didn't hear the last part of your question.
No. What is how do you trade? Because before we have come trading very large size of trade was more traded by voice, and is it something that has been changing, or is it still the case?
I think it's still pretty much the case. Even in my case, larger tickets definitely still executed by voice or Bloomberg chat, and then crossed in electronic market for simplicity, straight through processing, and quick and easy compliance to leave a paper trail. More so because working from home, of course, has some other issues in terms of again compliance and recording everything and having all the trail for everything. So Bloomberg chat maybe for OTC trades, maybe not exactly voice, but something similar, and then crossing. What I've noticed in the market in general is that in this working from home environment, those affected the most were over-the-counter trades in the interdealer broker market. So which were already kind of languishing in general, but were somehow present before the crisis, the COVID, because they retained the advantage of immediacy, and because they were voice deals over direct lines. With most of the dealers now working from home, it's impossible to have those open boxes with direct lines with all the broker shouting all the prices. So that's one of the, I would say that is one of the reasons why some marginal volumes moved to the electronic interdealer markets like MTS, and there are several others, of course, reasons.
Okay. Thank you. I think we are getting very close to the end of our panel. So just to conclude, and before we take questions from the audience, maybe we'll ask each of our panelists to do a quick conclusion about how we now trade in this market. The very low yield environment seems here to stay. So how could be the new investment trade, the lesson we may have learned from this crisis? So I will start. Ashley, Maria, and Gustavo. Just 1 minute, 1 minute conclusion. Thank you.
Low yield, we've been living in a low yield environment for quite a while, so it's certainly not a new phenomenon. we have seen those trends before March, and we're seeing those trends again. You know, investors investing down the credit spectrum, looking to longer duration, hunting for alpha, basically. So really nothing new. I think the new element here is the debt levels are much higher. So I think the way that monetary policy is going to be utilized to or implemented in order to manage that debt will be very key.
Thank you. Marek, if you'd like to conclude.
Yeah, from our perspective, no major changes either. Of course, as Ashlyn just said, I mean, the big change that we will all have to deal with in the aftermath of this crisis as sovereign issuers is the huge increase of the debt levels. Of course, we are for now in a very fortunate position with having yield levels that are so much below projected growth levels for the near future. That is a situation that I think we will need to take advantage of as issuers, and that might well rejoin the appetite that exists from the investor side for long duration. So I think as an issuer, being faced with these high levels of debt, one of the elements that you will need to tackle is spread out the maturities even more, and so that might rejoin the interest in the market for longer duration.
Thank you, Marek. Anthony?
I think when I look forward, there's a big challenge in terms of the amount of outstanding debt. But when I think of what's been achieved this year and the stability of the markets against the background of what we would have, if we'd anticipated this time last year, we would have nearly panicked at the idea of how much debt would have to be issued and how markets would respond. I'm more confident looking forward. I think that's the great thing of this year. It's shown us that we can deal with major crises. And the other issue of this year is that the primary dealing system has actually responded quite well to the crisis in general. Like, clearly nobody can mention the initial moment of panic when no one knows what's happening. But actually, once they had the stability of the EU, the primary dealership system worked quite well. And that gives me confidence again for the future.
Thank you, Anthony. Maria, a quick word for us?
Yes, considering that in this period we have noticed a good performance, I wanted to precise not only in terms of volume, but also in terms of tightening bid-ask spread in the screen, at least and in particular for Italy. I believe that with the larger mass of bonds, having a good trading venue to negotiate it, this would also be beneficial for the future European common issuance with the recovery fund issuance, sure, and so on. The perspective for the liquidity of the market is quite good. Also taking into account that the ECB has shown to be very careful in not drawing too much the liquidity of every bond. So the perspective on the liquidity and the trading are quite good in the next future.
Thank you very much, Maria. And finally, Gustavo, just in 1 minute, because we have 3 questions and would like to...
So yes, very quickly, I do agree with Anthony that one thing we learned is that markets as well as humans can adapt quite quickly to changes, and this happened very quickly at the beginning of the year. Then, of course, I must agree with the fact that we're in for low rates for quite some time, that investors will have to settle for lower limited returns for the foreseeable future. And hopefully fixed income markets will stay boring for a long period, given the sheer size that they've reached. So we simply cannot afford runaway inflation now and in the next few years. So but of course, one word of caution, because we never know. I would say it's way too early to declare the end of history, like Francis Fukuyama did in 1992. It's full of swans out there, and we don't know the color of each one. So it's good to be boring, but watch out for threats.
Thank you. So we have 3 questions from the audience. So I will start with the first one. So the first one is when the COVID-19 crisis is over, do you think trading from home will continue in such a form? And could it have diversity in work? So would like to take this question? Maybe Ashlyn or Anthony, please. Yeah.
Yeah, I was going to say that certainly from our perspective. Sorry, Ashley, you go first.
Yeah, I think, working from home worked. In March, we had, a super busy month. Everybody was at home, and, there was just general busyness, volatility in the air, and actually our networks worked, our phones worked, everything worked. If we had sat around a room a year ago and said in 1 year we're all going to be working from home, trading and sales, everyone, I think we would have laughed. So that was, quite miraculous, in fact. I think although we have established ways to enhance communication and, optimize the way that we trade with those people working from home, I do think that there are, huge benefits of being on a trading floor with your team, with traders, with sales. That information flow is much smoother, much more real time. But working from home can work for certain functions. Certainly, can work better than others.
Thank you, Anthony. You want to maybe add something?
Yeah, we moved office last year, and our new technology allowed us work easily from home. So technically, I think we can work like this quite easily. But I agree with Ashlyn that it's the need to meet your colleagues, the need for the interaction, probably more so for even younger people who haven't had the office experience. Those of us who've been around the time can visualize the people we're speaking to all the time. So I suspect the future will be a mixture. I think we will still end up going to the office a lot of the time, but we'll be capable the odd day when you want to do things to work from home. And that'll probably be the best of all worlds. Working from home can be quite lonely at times. So I think a mixture will be the solution going forward.
Yes, definitely. Thank you. So,
I fully agree.
Yeah.
The right mixture is the solution. Yes.
Yeah. We need to see people. We are social animals, so we need to meet each other. I think it has been quite the tough way to go through this crisis. Is don't see each other all the time as we used to. We have another question, which is due to central bank credit risk is not being adequately priced in higher risk debt. This hires the risk and event, very kind event at a later date. How do you comment on this? It's more common than a question. Yeah. And the question also would be that the agent, so it's maybe for more Marek and Anthony, has any government successfully implementing the blockchain technology for the bond market?
Sorry, I missed a lot of the questions. I'm afraid to say I can read them now.
Maybe, yeah. So yeah, do we have starting to work on the blockchain technology on the bond for the bond market at the sovereign levels?
Not that I'm aware of. No,
Yeah.
we haven't seen any real initiatives so far in that respect. So I'm not really closely following that either. But I don't think that there's any really big initiatives that have already started there.
I'm trying to remember. I have heard of one initiative. I think it may have been wasn't government in Australia, if I'm not mistaken, but I could be corrected. But it certainly hasn't been widespread yet, and I think it's further down the road before that develops. But it is something coming along the road.
Okay. Okay, thank you very much. I think we now have to stop our session. Thank you very much for your intervention and very, very interesting comment. I hope the audience, liked the session as much as we did. Thank you, and I will hand over to the next intervention. And thank you again, and have a very nice day, and hope to see you in Rio next year in Brussels for the conference, at least. Bye-bye, everyone. Thank you.
Thank you, Nathalie. Thanks. Bye.
Thank you, Nathalie. Thank you, every panelist, for such a great discussion. I wish we had more time. We appreciate the update and the lively discussion you shared with us this morning. I can join you in hoping that next year we will have this in a physical format, and we can all meet personally. We will now have a short networking break before our next session, which is a fireside chat that I'm delighted to be moderating, titled "The New Approach to Government Debt." We will see you back here at 10:15 GMT, that is 11:15 CET. I hope you will be back and watch the fireside chat. So see you back at 10:15 GMT, 11:15 CET.